All right. Hello and welcome to another Expert Inside interview. My name is John Golden from Sales Pop, online sales magazine, and Pipeliner CRM, joining you as usual from a sunny, slightly cloudy San Diego today. And I'm delighted to be joined by Cameron Bishop, who's in the middle of the country in Kansas City. How are you doing, Cameron?
Hey, thank you.
Yeah, and Cameron is managing director at Raincaster, and he has a lot of experience and CEO roles and working with companies and bringing companies to market. And what we're going to talk about today is we're going to talk about the top 5 mistakes that can destroy a company's sellability. Cameron, let's get straight into it. I mean, oftentimes most people, maybe they start a company and maybe they have an intention of selling at some stage, but it's always kind of something in the future. So rarely do people like prepare long time in advance. It's kind of something they make a decision on, and then when they talk to somebody like you or whatever, they realize that there's a lot of work they need to do to put it into to actually start that process. So what are some of the mistakes that people make then that they could avoid even when they're setting up their company? What are some of the things when you're even setting up your company that you could do to avoid destroying your sellability later?
John, you are spot on with that observation. I actually have taught a class for the Small Business Administration at a local university in the past for small business owners. And one of the first courses we take at a weekly basis is the fact that almost all business owners, when they start a company, don't have an end game in mind.
Mm-hmm.
And the sad fact of the matter is, eventually, every business owner is going to leave their company, and they can choose to do it standing up or in a box. It's bound to happen. So, an exit strategy should be part of the beginning strategy for any company as well. And one of the challenges these business owners face over usually the many years they own a company, and some of these are even second or third generation businesses, is that it's pretty much human nature that they spend 95% of their time or more working in their business and only about 5% of their time working on their business. And they don't understand that there's a general difference between running a company for revenue creation and tax avoidance and taking a profit or a distribution at year end versus running a company to build ultimate valuation in the business, which generally requires some different management decision making and usually some additional investment in the business. So those are kind of some of the foundational issues that can create a challenge for a business owner to actually be able to sell his or her company, or if so, whether they could sell it for a maximum valuation. In this day and age, I think the statistic is something like 10,000 baby boomers turn age 65 every day. Wow. And many of them are business owners because the boomer generation is very entrepreneurial. Mm-hmm. And the general trend is their children don't want to take over the business. So that leaves them in a position, if they want to monetize that, create generational wealth, is they're going to have to go out on an open market to sell the company.
Yeah, and one of the challenges, obviously, that raises, and I think a lot of this happens to a lot of businesses, is they maybe reach a revenue plateau, but it's not, and it's generating a good, it's generating good lifestyle income, and maybe you could generate, a decent amount, when it gets sold, but not enough. Not enough maybe to sustain, the business owner, maybe not enough to distribute to the family or whatever else you want to do. So they get caught in this situation of having to stay working in the business because they're at that point where it's generating enough for a good life, but not enough to sell at a premium.
You are very correct in that regard. Yes. And part of that challenge is obviously when these business owners decide it's time to sell, they generally sell. There's always exceptions, but the majority of these owners want to exit the business. And if they have not put any kind of succession planning in place, if there's not a number two in the organization that can step into their role, buyers are usually pretty hesitant to buy that kind of a company, or if they will, they're either going to create a very complex deal structure to mitigate their risk as the buyer, or they're just going to pay less money for the business to mitigate their risk. So these owners are oftentimes caught in a conundrum where they are required to stay on board
Mm-hmm.
for some extended period of time for knowledge transfer and to reduce risk for the buyers and to train some kind of a successor for them.
Yeah, and I think that's something. Yeah, I think that's something that sometimes takes people by surprise when the deal structure is you have to stay on and you've got a long earn out or something like that, which obviously makes sense from a buyer point of view because if everything is pretty much concentrated in the owner or in a couple of people, and those people want to leave the business, that's a huge risk for a buyer. So that's obviously
Yeah.
why they often structure it like with long earn outs, with all these different milestones, etc. So it's not a simple. I sell my business and I say thank you very much, give me the check, and off I go and sit on the beach.
Yeah. Well, that's often the vision, but it's rarely ever the reality.
Exactly. So just let's go through the top 5 mistakes.
Yeah. Yeah. So first and foremost, the thing we see, and again in our firm, Raincatcher, we're a lower middle market investment bank. So a lot of business owners contact us because their business is too big for a traditional Main Street business broker, and it's too small for the big investment banks. But they need proper representation because they often have complex financial structures or business requirements. But even in those companies, we're talking companies that are doing, kind of 2 million in EBITDA profits up to 10, 15 million.
Mm-hmm.
So they're going to sell for pretty good money. But
Yeah.
sadly, most of the time they have some fundamental flaws in their accounting structure or their accounting processes that are going to require extensive work by accounting professionals in order to get the books shipshape. Or in many cases, they're not sellable at all, or the company's actually making far less money than the owner thinks it's making once the accounting is properly structured on hopefully what's called a GAAP accrual basis versus a cash basis.
Mm-hmm.
So that's the single biggest factor we see that's an impediment to sellability or what a company can sell for.
Yeah, and that's a great one, I think, because uh, obviously when somebody, as you said, when they're running the business, when their head is in the business, when it's all about like generating, revenue or particularly cash flow, things like getting proper GAAP accounting up and running, may take a back seat, but obviously that can come back to haunt you.
It sure can, yeah. And number two, we've kind of touched on that, and that's the concept known as owner dependency.
Mm-hmm.
So if the owner of the business is the primary knowledge keeper in the business, if they have specialized knowledge or technology, or it's an engineering or intellectual property dependent business, and that owner is the primary or sole source of that, that's a real red flag. And especially if that same owner is also a key relationship or customer contact or business development person in the organization. And those, again, oftentimes make a company unsellable or sell for much less than it could if the owner invested in a broader organizational structure.
Yeah, it's nice being the face of the business, and it's nice when customers trust you and all of that kind of thing. But if it's to the point where you take you out of the business, then then the business, people aren't that interested or don't have the same relationship with it, then obviously that's a big risk to a buyer. In fact, you're not going to buy that business, are you?
Right. Or the buyer's going to make it a condition of sale that owner stays on for some negotiated period of time,
Mm-hmm.
which is usually counter to what that owner is hoping to do.
Yeah. So in those kind of cases, you kind of get the worst of both worlds, don't you? Where you have to try and force the owner to stay on. The owner doesn't really want to stay on, and it's not an ideal scenario.
Yeah. And a lot of times for these owners, it's difficult because they've been running the show for their whole career. And suddenly, if they've been acquired, now they're no longer the boss. They're reporting to somebody. And that's oftentimes a difficult transition for them.
Well, yeah, exactly. Because the other point too is, as we said, is it comes with earnouts, it comes with milestones, it comes with requirements. So now you're on the hook for everything that you promised during the sales process. So you don't get to walk away. And as you said, you may now go from being the person who made all the decisions, the top dog, to now you're taking direction from the new owners, and that can be a tough transition.
Yeah, it sure can. The third factor we see on almost every deal is when buyers contact us about a company we're representing. They say, what is the level of customer concentration? So the litmus test most generally is buyers don't want to see more than 20% of the company's revenue dependent on any one customer. And I've seen a lot of really great businesses that were making a lot of money. And when the buyers call, when they ask that question, they may not have had owner dependency. They may have had excellent accounting, but if they have some percentage of their revenue dependent more than 20% on one customer, that's an automatic elimination factor for many of these buyers. It's okay, we love the business otherwise, but we're out. And we see that a lot.
Yeah, and that yeah, exactly. Because I mean, oftentimes, especially when a business is starting or a small business, they land one big customer. That big customer tends to become the focus of a lot of things. You pour a lot of energy into it. You try and upsell, expand that relationship, hold on to it for dear life. But if you don't have other ones to offset it, then yeah, you have an imbalance in your portfolio.
That's right. And if they've checked all the other boxes correctly, but that's a big factor that they need to improve on. That's not an overnight change for a business. That could be at least a year, maybe 2, maybe 3 years to diversify their customer base and reduce that dependency factor. And it generally takes, John, about 9 months to sell a company. So if you had a business and you called me today and said, hey, Cam, sell my company for me, and we signed an engagement, the national standard average from engagement to deal closing, when that wire transfer hits your bank account, it's about 9 months. And most business owners, they kind of wake up and say, it's time to sell my company. And they're struggling with even that 9-month window. But if they've got to make fixes in the company for a year or 2 years, then they know they've got another 9 months on top of that. That's a struggle for a lot of them.
Yeah. And also sometimes, like, that large customer can be an anomaly. Your other little customers are all kind of fairly the same, but this bigger one is slightly different and you have to do a lot of work for it. So again, you're creating impediments to purchase.
Yeah. And ironically, again, if they're running their business for income, revenue, profits, tax avoidance, a lot of times those big customers, they keep giving you more business because you do great work for them. So it becomes a two-edged sword. You're making more money in the company, but you're exacerbating your sellability problem by having that same client represent an increasingly greater percentage of total business. So it's a fascinating factor for sure.
Absolutely. So what's number 4?
Well, number 4 is similar to customer dependency, but it's actually vendor dependency. So I had a client here about 1.5 years, 2 years ago. The guy was minting money. It was a great business. It was a very unique business. It was essentially a service type business, but he was completely dependent on a specific product. And he only had one vendor for that product. So his business, and there was no contracts between his company and the vendor for that product, and he had no secondary sources. And without that product, he actually didn't have a business. And we found most buyers were not willing to take the risk of that level of supply dependency from just one source for a pretty unique product. So secondary sources or diversification of vendors is really something that business owners also need to consider and evaluate.
Well, yeah, because you don't want to buy a business that's reliant on a single vendor and suddenly that vendor like whacks up their prices, or worse still, maybe somebody else or goes out of business or whatever happens. And now, as you said, you don't have a business anymore.
Yeah, that's very true. The fifth factor is again tied to accounting. So if a business owner is using accounting reports as a strategic business decision-making tool, and they are evaluating the performance of their company in various financial metrics on a regular basis, they will be able to track what their gross profit margins are. So that's their revenue minus their cost of goods and materials. So that gives them their gross profit and the percentage tied to that. And every industry has different parameters or metrics around gross profit margins. But again, when we're talking with buyers about any kind of business, that's one of the questions they ask is, what are their gross profit margins? Because if they are below the standards or the normalized rates or percentages for that particular industry, again, that's usually a red flag. Some will dive deeper into that to try to understand why and see if there's upside by buying the business and improving those margins. But generally, they're very reticent to buy a business like that. Or again, they're going to buy on a basis where the deal structure is very complex to mitigate their risk, or they're going to pay just less money for the business than they could extract from a maximum valuation standpoint if everything was on par.
Yeah, no, they're absolutely going to, as you would know, they're going to discount heavily on that. Um, and I think also, Cameron, is like sometimes people, even the calculations of gross profit and stuff like that, sometimes, especially in smaller businesses, they're not calculating in everything. They're not really. There's elements that maybe they're leaving out of the calculation. So when somebody comes in and does their due diligence, they could say, well, actually, if you look at all of the things that go into selling, your gross profit margin is actually lower than what you're saying it is.
Yeah, that's very true. The beauty, though, John, is if they've checked all of these boxes and then other various boxes that might relate to a specific company or industry, is that makes them very sellable. And if buyers see that the company is well run, well organized, and buttoned up, and they have succession planning in place, in our process, we will do a estimated valuation for them to kind of give them a range of what we think their company can sell for. And it's a really good market right now for selling companies, even though interest rates are still high. There's a big demand factor with increasing types of buyers in the marketplace. But we've had great success, frankly, especially over the last 2 or 3 years, of actually getting a greater price for the business than what we anticipated based on market norms, because buyers have a lot of confidence in this company based on what structured they are and organized they are and succession planning, all of those factors. So there can be increased valuation just for having all these kind of business disciplines properly placed.
Yeah, and I think that's the key point that you just made there, is having those business disciplines in place. And I think that's why when you're establishing your business and as your business grows, you need to get out of that kind of um, Wild West mentality as quickly as possible and get the processes in place, because sometimes like people put off like processizing and doing all these disciplined work because they're still running around just trying to grab business.
Yeah, that's very true. One of the other trends we're seeing is that almost all business owners, doesn't matter what the industry, but there are many industries that are like really hot right now for companies to buy, like HVAC businesses would be one example, is that they get contacted by somebody who wants to buy their business, and they just go with that rather than hire a professional to represent them and take the business to market. Because with just one buyer, so I spent 35 years of my career on the buy side doing leverage roll-ups for private equity firms, and I loved nothing better than to be in a non-competitive environment to buy a business, because I never paid top dollar for a company in that situation. The market sets the price on any deal, and unless you have multiple bids on a business, you don't really know what the valuation for your business is going to be.
Yeah, no, absolutely. I mean, we see that in the housing market now, where people are trying to do that. So I'll buy you unseen. Just here's your cash offer, and and people are getting taken in. And obviously it's significantly lower than what you could probably get if you went to a competitive market. But it is, I mean, I think that's where experts like you are so critical, because it's obviously if a buyer, if somebody contacts them and they were sort of contemplating, yeah, I was thinking about selling, and somebody comes up and says, oh, I'm going to make this really easy for you, it can be tempting.
Oh, very much so, because they think they can do it on a much quicker basis, but they usually have no idea how much they left on the table. And I'd say 95 or more % of the clients we represent have never acquired another company or never sold a business. So they really don't understand how truly complex the process is, especially around some of the legal factors on a deal. And they often say, oh, I heard some so-and-so down the street, one of my counterparts in the news, sold their company for X. And it's very rarely that the price is actually the realized price. By the time you deal with factors around the balance sheet, this very complex concept called net working capital, or how inventory was treated, how any property that went with the business was treated, if there are earnouts involved, or if the buyer requires the seller to carry back a loan on the business. All of these things, you see a big number at the top, but that's not necessarily the number they realized at the end of the process.
Yeah, no, absolutely. And I think that can be quite a shock to people sometimes as well. You know, the reality of what they actually walk away with, as opposed to what numbers are being thrown around at the beginning.
Yeah, for sure. So obviously it's a little bit self-serving to say, but whether it's me or our firm Raincatcher, our greatest advice is hire a professional, especially if you're in that lower middle market, 2 million, 10 million, you're going to generate a lot of money for that business. And we're also insistent on our clients using professional, experienced M&A attorneys, because again, those people pay for themselves usually multiple times over during the negotiation of the contracts, and a lot of these complex additional factors that ultimately impact the benefited purchase price, or what's called the total realized enterprise value on a deal.
Yeah, absolutely. Well, listen, Cameron, thank you so much. There's been some great insights. All of Cameron's information will be below this video. But before we go, you just did a moment ago, but just remind people again what Raincatcher can do for them.
Yeah, again, Judd, thank you so much for having me on. Again, my name is Cameron Bishop. You could reach me by email at cameron.bishop@raincatcher.com, or our www.raincatcher.com website, or I'm easy to find on LinkedIn as well.
Excellent. Well, listen, thanks again, Cameron. Thank you for watching and listening. And remember, if you're contemplating selling your business, go check out what Cameron does. It's not something you should do on your own, and it's not something you should do with people who are not specialized in doing it, because there is a lot involved, whether you're selling a small business or a big business. There's lots and lots involved. All right. Thanks again, Cameron. Thank you for watching, listening, and I will see you all again very soon. Thank you.